there, very good evening and welcome to The Big Picture, where we take a closer look at one of the top stories of the day. I'm Tracy, Shilshi, and today we're focusing on the markets and of course the economy at large, following of course that RBI rate cut that we saw yesterday. What does that rate cut mean, and the other policy measures that the RBI Governor Raghuram Rajan announced to consumers and also the broader economy? Well, to help us understand that, we have an esteemed panel joining us. We have, of course, Dr. Arbind Prasad, who's the Director General at FICCI. We've got Professor N.R. Bhanumurthy, member of the NIPFP, which is the National Institute of Public Finance and Policy, and also Ishan, Bakshi, who's the Assistant Editor at Business Standard, joining us this evening. We also have Ms. Renu, who is a former IMF and RBI staff member, joining us from the capital as well. Dr. Prasad, if I could start with you. This rate cut, especially that we're talking about, is this a bold move, as you know, some investors, of course, are calling it, some experts are calling it, but the RBI governor, of course, saying that he's not being aggressive, he was just using the room that he had. What would you call it?
Well, whether you call it bold move or not being aggressive, but ultimate outcome, particularly at this time when it is just coming before the festive season, will first, it will give a boost to the consumer demands, particularly in housing, auto, consumer durable goods, and all these sectors will give rise to the cyclic investment, real estate. Several industries are related to that: cement, iron, steel, electrical goods, domestic, furnishing, and all those industries. More than 200 industries depend on the real estate industries. The investment till now, there has been a very low capacity utilization, about 70 to 75%, and therefore there was no new investment taking place in spite of several initiatives being taken on ease of doing business by the central government, by the state government. So to that extent, this will definitely has come at a right time. Particularly, it has come at a rate which people didn't expect. Most people at the most expected 25 basis point.
Yes.
Some other announcement he has made that there is a positive move. This inflation being low, he says that it will continue to remain low, and there will be a supportive reaction from the RBI, essentially indicating that there will be further cuts in coming years. So this gives a positive signal. Also, he has mentioned that he will be working with the government of India, essentially for the banks to pass on this cut to the consumers, and which essentially meant, if you were reading between the lines, that the government of India will reduce the interest rate on a small saving, so the deposit rates and the lending rates the banks will be able to pass on. The RBI had reduced the repo rate by 75 basis point over this year, but the banks did not pass on much, 25 basis point or something. This time, the government of India has also indicated it will support that, and there is an indication the banks will really pass on. In fact, the State Bank of India, Andhra Bank, Bank of India, they all announced a reduction in their benchmark rate the same day. In ICICI Bank, though did not specify, but Chanda Kochar also said that the ICICI Bank will also reduce the benchmark rate. So there is every indications that the inflation and thereby the interest rate will be lower. The RBI governor has also announced that the FPI investment in government bonds will be enhanced, essentially saying that gilt rate, the government bond rates will also be going down, essentially saying that overall interest rate will be low. So all these announcements has the potential for enhancing the consumer demand and thereby industrial investments.
All right. Ishan, if I could talk to you about the markets, the bulls finally gaining some ground. If you could see the Sensex, in fact, around 300 points that it's gained in the past two sessions. But, a lot of experts also saying that this is not something that can be sustained, because there are a lot of global factors as well on which the Sensex keeps going up and down. We've seen, of course, how the China story has affected it in the past month or even more. What do you feel? Has this actually given a booster of sorts to the markets?
So if you look at it, you need both monetary policy and fiscal policy measures to drive us out of the condition that we are in right now. What the market saw was Raghuram Rajan being aggressive in the sense of front-loading rate cuts, 50 basis points, and they see the monetary policy doing the heavy lifting right now. So there was, in a sense, some breather that some policy instruments are being utilized by the central bank to sort of give a push to growth rates. Now we want to see what happens next with the government. What are the measures that the government takes now? Because it cannot be just a monetary policy that is driving up growth. The impact of the measures that Dr. Prasad was talking about, it's all going to happen with a lag. Now, whether we have time for that lag effect to actually materialize in the economy, because private investments are falling, public sector investments are falling. Expecting that government alone will push up investment cycle is not going to happen to that much of an extent. The effect has to be on both private sector and public sector investments to get them in also in the economy. So to that extent, I think the markets it was a breather rally, but I think they're going to temper expectations going forward, because there's a lot of uncertainty in the global arena as well. And if you see, our export data has not been anything but bad. I mean, it's been very down for the last 6-7 months on a stretch, and the global economy is a very precarious situation. What's happening in China and the Eurozone, so we don't know what's actually going to happen in the coming months.
Absolutely. Ms. Kohli, if I could come to you, the RBI governor saying that he wanted to make sure that the words sustainable and growth go together, and this is where taking off from Ishan's point, not just on the monetary policy, the government also needs to really work on making sure that everything goes hand in hand. Do you agree with that?
Yes, definitely, because ultimately, let's look at it. The joint effort on the part of the government and the Reserve Bank is basically distills into using macroeconomic policies, monetary as well as fiscal, to revive demand and or economic growth. Now, it is well known that macro policies can only assist and facilitate a cyclical recovery, and for growth to pick up from there on and take over the leadership driver of growth, there have to be other productivity boosting and efficiency gains from elsewhere and other parts of the economy. Now, the fact is that in India, we need structural reforms which could do that, and there are plenty of areas on the supply side where capacity constraints are clearly visible. Right now, our economy is segmented into two parts, which is that there is plenty of slack or excess capacity in the manufacturing segment, but at the same time, if you look at the services side, there are issues, there are segments which the governor also referred to, areas like education, medical services, where prices tend to be very sticky. They do not come down, and there is plenty of capacity constraints. Then another area is that of agriculture markets. We do not have we have a huge gap between wholesale and on the retail side. So we can look at it in terms of lifting the economy from the trough that it is currently in and the adverse economic conditions that we have right now, which runs the entire gamut. There are, on the balance sheet level of both firms as well as banks, there is excessive leverage, and therefore there is a huge amount of consolidation and repair that has to be going on. So to that extent, monetary policy will definitely help, as will capital spending by the government in order to replace the vacuum caused by lack of appetite for private investment. But it can only lift it up to a point and no more. Beyond that, you would just find it's not sustainable. So when the governor says about sustainable growth, we must look at it jointly on, we should look at it in terms of macroeconomic policies, that is monetary and fiscal, and we should also have structural reforms on the other side, rather parallel to these efforts, because structural reforms typically bear fruit with a lag of a couple of years. So we should not waste that opportunity.
All right. Bringing in Professor Bhanumurthy at this point of time. Professor, what do you think really is now going to be pushing the India story forward? Do you think, key factors that would be required for driving growth would, of course, GST be one of them? Perhaps easing off, that the problem of non-performing loans. Are those some of the factors that, the government also needs to be looking at more seriously?
Yeah, I think it's very important for us to understand the overall transmission mechanism from what we have seen yesterday, the governor's decision to cut the repo rate, and how the banks are going to transmit to the consumers as well as the producers. as we have seen in the past, although there was a reduction of repo rate by 75 basis points, we just have seen only 30 basis points transmitted to the loan segment. So if this kind of very rigid transmission mechanism if you have, I doubt how far this cut in the repo rate yesterday is going to transmit to the growth. But I think Governor Rajan has already very clearly pointed out, and I think even the Finance Ministry also said that it's very important for the banking sector to transmit. One needs to understand that this has also been augmented by capitalization of some of the banks, which the Finance Ministry already pointed out. So the underlying point I'm trying to say is that the complementarity between the monetary and fiscal policies, as other panelists have already raised, is very, very important. And the monetary policy has always been playing a supportive role. And only this time round, the fiscal policy seems to be in coordination with the monetary policy, because we need to understand in the first quarter of the current financial year, there is a very, very positive, indicator where the public capital expenditure has gone up actually in the current year compared to what we have seen in the last year. So the call for higher capital expenditure by the government sector is already been made, and I think going forward we are going to see some more capital expenditure by the government, which would or should at least crowd in private investments going forward. But at the same time, I think one needs to really understand right now the both external conditions as well as the domestic demand conditions are very, very subdued. Again, it's very important for the fiscal policy to create a demand conducive atmosphere, particularly in the rural segments. I have written on this where if you look at the kind of public sponsored programs, there is a slack in overall expenditure. Yes, you are concentrating more on capital expenditure, but right now, if you look at even the industries are actually arguing for creating more demand conditions. That can happen only if you continue to allocate more resources to the rural development programs, particularly this year, where we are seeing a very, very bad agricultural situation in the rural segments.
Yes, that was in fact one of the factors I wanted to talk to you as well, Dr. Prasad. Is that one of the concerns also of India Inc. at this point of time, the industry in general? Are they also looking ahead, with that perspective in mind? The RBI governor, of course, doing, like he said, doing whatever he can within his capacity, not being too aggressive, also in fact saying that this is not a Diwali bonus, is what he had pointed out. What are the forward-going factors that are, worrisome, in fact, for India Inc.?
No, the RBI governor also hinted some of them, and other panelists are pointing out the rural economy, demand in the rural areas, particularly because of unexpected poor monsoon performance, the global economy in the sense of the export performance, and these are the infrastructure issues, the NPAs for the bankings. So all the panelists have pointed out, and to that extent I fully agree that the RBI monetary policy alone cannot take it too far. But we expect that the government will continue to do its own part of activities, particularly the export slowing down. From the industry, we have been asking for that the interest subvention scheme, which was there till last year, to reintroduce, and government should do that. There are other policy issues like simplification on taxes, GST, which has been pending for some time. There is need to, fast track. Government is trying to do that. Issues on other sectors like infrastructure investment, power sector, the ease of doing labor reforms, which all these are in pipelines and so in some sense work in progress. That has to be done in a very aggressive mode. The other panelists pointed out the difficulties on service sectors and the supply constraints. There is need to, the government is focusing on skill development. There is need to focus on that, so the service sector, be it health, be it education, other sectors, we have adequate manpower, we have young population, but they need to be trained to be productive to provide those services. So the RBI governor has done his own part of the activities,
yes,
and he has give an indication that he will continue to support it. But naturally, the government, particularly the central government and now the state government, just recently you saw the World Bank release the ranking about the reforms taken by the different states. So states are also competing among each other. I hope that all these, along with RBI's initiatives, all these activities will continue, and then the support to economy would come.
That's in fact one of the the stories that we get to hear, isn't it, Ishan? That the government, of course, as far as reform policies are concerned, unable to carry out a lot of those big reforms due to politics, of course. And there's an added pressure really on Raghuram Rajan really to somehow give some sort of confidence to investors in some way possible. Is there an added pressure on Raghuram Rajan? Do you feel so?
So absolutely, what every panelist over here has also said is that you need both monetary and fiscal policy at this moment. But what you also need to understand is that the government, when you talk about fiscal policy, we only talk about central government expenditure. We also have to look at state government expenditure and PSU expenditure. PSUs are reportedly sitting on cash worth a couple of lakh crores. Now, if you just release that in the system, you get the capital expenditure cycle going. So you need to look at the sector-wise where all investments can be made. We all know the mess that power sector is in, or the oil and gas sector is the mess that everybody else knows. We need to start getting the investment cycle going. Roads is one area where some traction is being seen, especially rural areas. We also need to see what's happening in railways, what the capex cycle, how is that going to play out. So these are two areas where this government, I think, has bet heavily on the roads and railways, and it's hoping that these two sectors are able to push the capex cycle back going.
Ms. Kohli, also just talking, since we are talking about, a booster to the economy, is this a dose, is this a booster dose to the economy by Mr. Rajan? Just talking about the rupee as well, a lot of financial experts do say that it has, of course, slumped. It has seen a lot of volatility, but compared to the other currencies, it has in fact been able to sustain that China story. It has been able to maintain, some sort of strength compared to other currencies. Do you agree with that?
In comparative terms, to an extent, yes, but it remains to be seen how prolonged the financial volatility is likely to be, and from all accounts it seems that it's not going to dissipate or work itself out in the global economy very quickly. It is going to be prolonged, and therefore India is, we must remember, is not really immune to financial shocks. Rather, it is quite susceptible. Now the thing is that we have seen that on the financial side, so far, India is supported because very favorable conditions on the oil prices and commodity prices, which is sort of limiting or containing the import bill. So therefore, the current account deficit is in somewhat restrained, even though exports have fallen very rapidly. But then, in the last few months onwards, I think July onwards, we really have very shrinking capital inflow, and in fact, it has been negative for all these last 3-4 months, except for the marginal some net positive 800 million or so. Now, just yesterday there has been an assessment by the International Institute of Finance, and it notes that in this last quarter, July to September, the capital outflows from all of emerging markets has been the heaviest since 2009. And if that goes on, I do think that there might be, the currency may come under pressure. At the same time, we do have far lesser adjustments in terms of previous past overvaluations, because the inflation differentials are very narrow right now and there isn't substantial overvaluation. So we would not expect too much of steep depreciation, and even if there were to be those kind of conditions, the RBI does have the firepower to moderate the path of depreciation should the eventuality arise. And in any case, it has been sort of on a weakening note by and large in the last couple of months. I would just like to add one point to the point made by the previous panelist about the major concern. I would say that the major concern, both before the Reserve Bank and the government at this point, is that of the NPA stress, that is bad loans. Now that is a very serious issue, and it doesn't appear, by all accounts, it seems that they are continuing to mount and there might be fresh slippages into bad assets from the steel sector, sectors which have now come under enormous stress and which earlier have not piled up or bunched up into NPAs. Now there has to be some kind of resolution, whatever it might be. It is not that efforts have not been made, but for various reasons in the last 1.5 years, not much action has taken place in terms of cleaning up the balance sheets of the banks. Now, so you see, you have stress of leverage on the corporate side, on the firm's balance sheets. If I have already, reached an average debt to equity ratio of 14 times, then I'm not going to borrow anymore. And neither on the other side, the lender, the bank, is going to extend any credit to me simply because of past accumulated debt. And number two, also because my own balance sheet, that is the bank, is also damaged and it's under enormous stress. So there is the key major economic problem is there, and I think is at that point, and that is something very serious for the RBI. To an extent, a reduction in interest costs will help in alleviating that distress, but only that much so. It doesn't really, it's not enough to recover or past damages. There is a structural issue out there. Banks' balance sheets are really bad. So, recapitalization and what is to be done with the existing debts, etc., which ones are viable, a lot of them become viable only as the economic cycle or growth picks up. But obviously it hasn't happened in the last 1.5 years. So the problems got compounded. And, if you see global as well as domestic, there is no demand visible on the horizon. So, that's the problem that I wish to flag.
All right. One another interesting thing that Raghuram Rajan also said was, Prime Minister Modi's foreign visits really need to be translated on the ground as well. He's talking about trade with different countries, but on the ground, we're not seeing much of foreign investors coming in. Professor Bhanumurthy, higher investment by foreign investors really, especially in government bonds, is that also another way really that can help in that cash inflow?
Yeah, I think given the current external situation, particularly because of ambiguity in the US federal interest rate policy, relying more on short-term foreign capital flows, I think is not a really advisable policy. I think as Renu already pointed out, the report, yesterday's report also says that India seems to be one of the favorite destination for foreign investments. So given this kind of mixed kind of a picture in the international markets, I think the US Federal Reserve, clarity on the US Federal Reserve will help India to attract more foreign investments. Having said that, I mean, if you look at borrowing by the domestic industry, one of the things which many of us have missed in the credit policy yesterday was that the part B of the credit policy, where the RBI seems to be coming out with many more, policy measures where the domestic corporate sector would be allowed to borrow from the international market by floating rupee bonds. I think there are many other issues, many other policy measures RBI is taking to help the domestic corporate to mobilize more resources for their expansion activity.
All right. We'll have to, of course, wait and see if this rate cut, and of course, like you guys are pointing out, if the government, of course, does something as well to support this monetary policy, if it does get elevated to something else, is this going to be the eventual Diwali bonus we're, of course, waiting for? But in this, volatile situation that we're seeing, we're hanging on to any good news possible. For now, of course, we're happy with that rate cut. Thanks to to my panelists, of course, for joining us, helping us understand this story. There's a lot more aspects, but that's about the time we have on the big picture. Thanks so much for joining us. The news continues after this break. Stay with us.